Great. Well, thank you everybody for being with us this morning. We're grateful that you would take time out of your busy days to join us, either watching live or after the fact on YouTube, on our YouTube channel. We're very grateful to BKD for helping us break down a few of the tax and other accounting issues that our Utah businesses are facing right now. BKD is a national CPA and advisory firm with 40 offices in 18 states, including right here in Salt Lake City. And we've got some great expertise on the call today, or on the webinar today. Before jumping in, I thought it would be helpful just to start with a quick recap of what World Trade Center Utah is doing to help Utah businesses right now as we're all facing unprecedented challenges. First off, we've been hosting a series of webinars, and we're grateful to all of our members and our partners who have been providing expert substance to our Utah companies. We've done webinars ranging from the view from China with legal experts in Beijing to give us an on-the-ground perspective there. We've done webinars on contracts, acts of God, force majeure, and what that means to Utah companies right now. Also on the Families First Coronavirus Response Act, as well as the CARES Act, including with the SBA, in terms of all the loans that are available to Utah companies right now. World Trade Center Utah is also a part of the governor's Economic Response Task Force. In that capacity, we are leading out on the Federal Engagement Committee. And so we are tasked with working with all of Utah's federal partners, the SBA, the Commerce Department, Customs and Border Patrol, the FDIC, and others on convening these federal partners, working very closely with our congressional delegation and other key stakeholders here in the state, so that all of us involved with any sort of federal engagement are working together to maximize the number of Utah companies and individuals that are able to participate in these federal stimulus programs that have occurred in phase 1 and 2, and the very significant ones that are being rolled out right now as part of the phase 3 CARES Act. What we've been doing there is working with all these partners to make sure we are pushing accurate, concise information out to Utah businesses. You can find that information on coronavirus.utah.gov/business. We highly encourage everybody to go there and read up on some of the details on what is included in the stimulus package for Utah small businesses. And BKD is going to shed some light on that today for us as well. We've also been working very closely with our partners at SBA and with this federal committee to stand up a rapid response team to support the SBA as they are dealing with a tsunami of emails and phone calls, applications and requests. They simply can't keep up with everything with the team they have here in Utah. And so today we are doing our first training with 25 volunteers spread out across 10 or 11 different organizations who will be trained up to plug in behind the SBA so that our Utah businesses can quickly get responses to their questions, get applications processed, and get a hold of these resources that are so desperately needed right now. And so with any of this, if there's anything that World Trade Center Utah can do to help, please reach out and let us know. You can find all of our contact details on our website, WTCUtah.com, or shoot us an email at info@WTCUtah.com. But again, we're so grateful to have Will James, Julia Dangle, and Yelena Bosovic join us today from BKD, because you do want to get an accountant's perspective as you're looking at the different options, as you're working to respond to the challenges that we're all facing right now. And so I'll quickly introduce all three panelists, and then I'll turn it over to them and let them take it from here. So Will James is a member of BKD's International Tax Service Division and leads their transfer pricing practice. He has been a dedicated transfer pricing consultant since 1992, primarily working with large international accounting firms and advising clients on various transfer pricing and tax valuation needs. Will has experience in transfer pricing planning, documentation, advanced pricing agreements, intellectual property valuation, cost-sharing arrangements, and transfer pricing controversy for clients in multiple industries. Next, we have Julia Dangle. Julia joined BKD in 2013 and is a member of BKD's National Office Tax Department. She works closely with the Director of Tax Quality Control on firm-wide tax projects and support-related tasks. She has experience providing tax services to a variety of businesses and individuals. Yelena Bosovic is a member of BKD's National Office Tax Department providing support to the firm and its clients on various tax issues for individuals and businesses. Yelena joined BKD in July 2019 after spending 3 years working in international tax consulting for PwC, where her practice focused on advising multinational clients on potential U.S. and foreign tax implications of tax planning. She has a JD from the University of Missouri, Columbia School of Law, and a bachelor's in finance and economics from Drury University. So Will, Julia, and Yelena, thank you so much for being with us. At this point, I believe I'm kicking it over to Julia and Yelena. Is that correct?
Yep, that's perfect.
Okay, thank you. I'll let you take it from here.
Sounds good. Thanks, Miles. So today we're going to cover some of the major tax-related updates that have been coming through in response to the COVID-19 pandemic. Those are pretty pictures. So the agenda for this morning's webinar, we're going to start off with the tax day postponement, and then we're going to shift into some aspects of the Families First Coronavirus Response Act, and then the recently enacted CARES Act and some other legislative updates there. And then we're going to wrap up today's webinar with some international tax and transfer pricing considerations. So as you all have likely heard by now, the April 15th tax filing and payment deadline has been postponed to July 15th, 2020. And so now taxpayers can defer filing and payment of federal income tax until that date without interest or penalties, and that's regardless of the amount that's owed. And so this includes payments on tax on self-employment income as well. And the postponement applies to all affected taxpayers, which includes individuals, trusts and estates, corporations, and other non-corporate tax filers. Now, the current guidance that we have doesn't affect the due date for second quarter estimated tax payments. So those are still going to be due on June 15th, 2020. It's a little funky. Your Q2 payments are going to be due before your Q1 payments, but that's the guidance that we have so far. So that's kind of what we need to go with. For state tax filing and payment relief, taxpayers will need to continue to monitor those on a state-by-state basis. And something I'll point out is that the AICPA actually has a nice resource that tracks those state tax and legislative developments. So you can find all those state developments in one spot. So you don't have to keep hunting them down for all the various states that you may be doing business in. So after the IRS and Treasury expanded the tax deadline relief from just certain payments to all payments and filings that are due April 15th, there were still some outstanding questions because, well, tax is complicated. So in response to those questions, the IRS put together a series of frequently asked questions. And these FAQs clarify that this relief allows taxpayers more time to contribute money to their IRAs for 2019. The FAQs also provide a specific list of form numbers to verify whether a particular filing is subject to this postponement. And the FAQs also address the treatment for fiscal year filers. So it states that if your federal income tax return for your fiscal year ending during 2019 would be due on April 15th, whether that's the original due date or the due date on extension, that due date will also be postponed to July 15th, 2020. Now, this past Friday, the IRS issued Notice 2020-20, which postpones the federal due date for filing Form 709 and making those federal gift and generation skipping transfer tax payments, and aligns that again with that July 15th due date. So next, I'm going to turn it over to Yelena to start our discussion on the Families First Coronavirus Response Act.
Thank you, Julia. So Families First Coronavirus Response Act is the second stimulus package that Congress passed. President Trump signed it into law on March 18th. It is basically a mandate for employers with fewer than 500 employees to provide up to 12 weeks of paid leave for employees who are unable to work or telework due to circumstances related to COVID-19. And it offsets the costs of providing that required leave with refundable tax credits against employment tax. The paid leave provisions under the Families First Act are effective April 1st and will only apply to wages paid for the period beginning on April 1st, 2020 and ending on December 31st, 2020. The IRS and the Department of Labor intend to issue a temporary non-enforcement policy that provides a period of time for employers to come into compliance with the Act. Under this policy, labor will not bring an enforcement action against any employer for violations of this Act, so long as the employer has acted reasonably and in good faith to comply, and instead labor will focus on compliance assistance during this 30-day period. An employer, including a religious or nonprofit organization with fewer than 50 employees, is exempt from providing this emergency paid leave when doing so would jeopardize the viability of the small business as a going concern. This determination should be made by an authorized officer of the business and documented properly. For example, if complying with the provision of paid sick leave or expanded family and medical leave would result in the small business's expenses and financial obligations exceeding available business revenues and cause the small business to cease operating at minimal capacity, that would rise to the level of hardship exemption based on the DOL guidance issued this far. And we've included a link to the DOL frequently asked questions page where you can find more guidance on so far what the Department of Labor has provided, but we do also expect them to issue formal regulations here shortly. Healthcare providers may also be exempt from the Family's First Aid paid leave provisions. For employers of an employee who's considered a healthcare provider or an emergency responder, and you can find the definitions for those on the FAQ page, you have the option of electing to exclude such an employee from the application of these provisions on an employee-by-employee basis, in addition to any exemption that the labor regulations may provide for your industry. So we're going to go through and talk about each of the two provisions that kind of play together, or they're meant to work together. First, the Families First Act expands the Family Medical Leave Act to provide up to 12 weeks of FMLA leave for employees who are unable to work or telework due to a minor child's school or daycare being closed as a result of COVID-19. The first 10 days are unpaid, but this again interplays with the paid leave section under the Families First Act because an employee can elect to use paid sick leave, accrued vacation, or other forms of paid time off for the first 2 weeks of leave. So for example, if Jane no longer has childcare because her 8-year-old son's school is closed for the rest of the school year due to COVID-19, the nature of her job is that she can't go into work or work remotely because she doesn't have childcare. So if Jane has no accrued sick or vacation days, she can use the paid sick leave under the Families First Act for the first 2 weeks and then transition to the FMLA leave for the remaining 10 weeks. If Jane did have accrued vacation time, her employer can't make her use that time instead of taking the paid leave under the Families First Act. It is up to the employee to choose what type of leave they want to substitute in for the first 10 days that are unpaid under the expanded family and medical leave. If your company or organization is subject to the Families First Act, you're only required by this law to provide up to $200 per day and $10,000 total for each employee. Wages paid under this provision are also limited to 2/3 of an employee's regular pay. Should you choose to, you may supplement and pay more, so you can pay their full wages. But as Julia is going to talk about later, your corresponding payroll tax credit is capped at the statutory limits, so at the 2/3. So anything over that is expected to be paid out of your own budget. This part of the Families First Act relies on the rules under the FMLA regulations and the Fair Labor Standards Act. So if you have employees that you expect to use this type of leave, you should consult an attorney if you're not sure if, one, you qualify for this, or two, what employees qualify. So the second portion of that is the emergency paid sick leave. So this provision is a bit more broad because there's a list of 6 types of leave that qualify for up to 80 hours of paid sick leave for full-time employees, and part-time employees are eligible to take the average number of hours. They generally work in a 2-week period. Paid sick time under this provision does not carry over from year to year. So I'm not going to read this list, you can see it on my slide, but this can essentially be put into 2 buckets. The first 3 types of leave is leave to take care of yourself, and the last 3 is leave to take care of someone else. So if you're diagnosed with COVID-19, you're seeking diagnosis, or are subject to a government isolation order, that's self-leave. If you're a caregiver for someone else facing these circumstances, well, we're labeling that as family leave. This is important to distinguish because if an employee's reason for taking leave is in the first bucket of self, they're eligible to receive 100% of their wages for up to 80 hours, capped at $511 per day and $51.10 total for each employee. If you're in the second bucket and cannot work or telework because they're taking care of someone else, you're entitled to 2/3 of regular pay, which is capped at $200 per day and $2,000 total per employee. So Julia's going to walk through how the tax credits work to help subsidize this, and then also how those two credits kind of work alongside each other.
All right, thanks, Yelena. So as Yelena mentioned, there is some help to subsidize the cost for employers to actually provide these paid sick and paid family leave benefits. And the Act created a series of refundable payroll tax credits that employers can claim on a quarterly basis on wages paid through 2020. Now, in addition to the amounts paid related to the sick or family leave itself, employers will also receive a credit for the amount of qualified health plan expenses and their portion of Medicare tax that's allocable to that qualified leave. Also, an important note here is that any sick or family leave wages that are paid under the Act are completely exempt from the employer's portion of Social Security tax. And as a reminder, self-employed taxpayers are also eligible for a refundable credit against the income tax paid on those earnings that are subject to the self-employment tax. Now, as Yelena mentioned, the effective date of these provisions has been a bit of a hot topic since the Act was passed. However, Notice 2020-21 came in and actually clarified that these provisions are effective for wages paid for the period beginning on or after April 1st, 2020, and then it extends through December 31st, 2020. And the mechanism for actually claiming these credits, while we're getting more information about it, it isn't entirely certain at this point. The IRS has released some unofficial guidance that indicates that employers may decrease the amount of payroll tax that they remit equal to the amount of credit that they expect to receive under these provisions when they file their quarterly payroll tax returns. In addition to that, the CARES Act, which we're going to talk about later in this webinar, it also provides a cash flow relief mechanism for companies eligible for those credits. Okay, so let's go ahead and dive in to these credits and take a closer look. So the paid time, the paid sick leave time payroll tax credit is limited to $511 per day, $5,110 in total if an employee is taking time off to care for themselves. So that's situations 1, 2, and 3, and 6 on that previous slide that Yelena showed. Or it's $200 per day, or $2,000 in total if the sick leave is to care for an individual who is quarantined or showing symptoms of COVID-19, or they're caring for a minor child whose school, daycare, or other form of childcare is unavailable due to COVID-19 precautions. So that's situations 4 and 5 on that previous slide. Now, for employers that pay family leave wages under the Act, a separate payroll tax provision allows a credit of up to $200 per day, $10,000 in total, for employees requesting leave specifically to care for a minor child whose school, daycare, or other form of childcare is unavailable due to COVID-19 precautions. And again, that's situation 5 on that previous slide. And as Yelena mentioned, the expanded family leave benefit is available for 12 weeks. However, those first 2 weeks are unpaid unless covered by another benefit that's at the employee's choosing. And so that's where the total cap of $10,000 comes in. It's 10 total possible weeks of paid leave at $200 per day. Now, notice that in any situation where the employee isn't the one directly affected by the virus, the employer is only required to pay that 2/3 of the employee's regular pay. And again, just to reemphasize this, the employer can pay the employee more than this amount, but they're only going to be subsidized for that 2/3 that they were required to pay. So to help demonstrate how these credits work, we're going to run through a couple of quick examples. So in this first example, we have Sally. She is a full-time salaried employee who's unable to work from the office or remotely because her 8-year-old child's school is closed and she doesn't have anyone else who can help care for her child. Her annual salary is $100,000 and she's unable to work for 9 total weeks. So in this situation, we'll also assume that she's been with the company for at least a month. So first of all, notice that Sally's reason for being unable to work falls under both the paid sick leave and the expanded paid family leave provisions. And because of this, she will be able to use up the 2 weeks of paid sick leave during that 2-week unpaid period under the family leave rules, in addition to the up to 10 weeks of paid leave under the expanded family leave provisions. Also, it's important to reiterate that the employer can pay Sally more than the 2/3 of her normal salary in this situation, but they're only required to pay 2/3. So in this example, if the employer pays Sally 2/3 of her normal salary, which comes out to about $256 per day, it would be over the daily cap of $200. Therefore, Sally's leave pay and the employer's credit on that pay would be $200 per day for 10 days, 2 business weeks of sick leave, and then $200 per day for 35 days, 7 business weeks of paid family leave. All right, so let's look at one more example. And in this example, we have Joe. He's a part-time employee who requests paid leave for 2 days because he has to self-quarantine at his doctor's advice. Now, Joe is normally scheduled to work for 4 hours per day, and he's paid $15 per hour. First, like we did in the last example, we need to determine which type or types of leave Joe is eligible for. Now, his situation falls under the second condition shown on that previous slide that Yelena covered. A healthcare provider has advised him to self-quarantine because of COVID-19. Accordingly, he's going to be eligible for paid sick leave for the 2 days that he's unable to work. In addition, that paid leave is subject to a higher cap than if his leave was related to caring for another person. Now, he's not going to be eligible for the expanded family leave in this situation. His situation doesn't cover that. So in this example, Joe's daily wage is below the cap, and he's eligible for total paid leave of $120, which is fully subsidized for his employer. Now, for both of these examples, keep in mind that the employer would also be able to claim any qualified health plan expenses and the employer's portion of Medicare tax related to those wages as an additional credit. And we realize that these computations are complex. I mean, these are some simple examples, but when you're thinking about multiple employees that are qualifying for various types of care, various types of leave related to COVID-19, it can get pretty complex and confusing pretty quickly. And we encourage you to reach out to whoever your tax advisor is to help with these calculations. And BKD has actually developed a model which helps our clients calculate their payroll tax credits and the related wage exposure under these new rules. All right, so next we're going to move into some commonly asked questions related to the Families First Act. These are questions that we've been getting on a daily basis, and we figured that if we're getting them from our clients, you guys may be wondering about these things yourselves.
Yeah, so our top asked question is, does this apply to me, and how do I calculate the 500 employee threshold? Does this apply on a consolidated level? Who counts as an employee? So the way these provisions are set up is the paid leave provisions rely on existing rules and regulations under the Family Medical Leave Act and the Fair Labor Standards Act. Not a labor attorney, and this is not legal advice, but our understanding is that it isn't as simple as adding up the number of employees you have. For example, workers who are independent contractors under the Fair Labor Standards Act, rather than employees, appear to not be considered employees for purposes of this rule. Additionally, the Fair Labor Standards Act includes a concept of joint employers for corporations that have ownership interests in other corporations. Similarly, under the FMLA rules, there's an integrated employer test that may require multiple entities to aggregate their employer count for purposes of these provisions. And these rules are complex and rely on a balancing test of various factors, including who makes firing, hiring, and pay decisions. So we're recommending our clients to consult with their attorneys to determine if they're subject to these paid leave provisions, especially if you are close to that 500 threshold for either on a consolidated basis or an entity by entity basis. So the next question we get is, do these rules apply to layoffs or companies that shut down because their main source of income is cut off? So these paid leave provisions are not meant to be to help necessarily in this situation. They're more meant to be temporary leave for employees who can't work because they're sick or taking care of someone who's sick. So if you have situations where you have employees who are being laid off, furloughed, or a company that's going out of business or closing due to COVID-19, including shutdown orders, You want to go look more towards the CARES Act provisions, which do have some aid and relief for businesses and employees who are facing those situations. The Families First Act is solely for paid sick leave or family leave. So employees who are laid off should also contact their state workforce agency or state unemployment insurance office. They can help with unemployment benefits. The next question we get asked is, are these wages subject to FICA taxes? So Julia kind of hit upon this, but the paid leave provisions are exempt only from the employer's portion of Social Security tax, and the employer's portion of Medicare tax paid is also refundable. So you add that into your credit. The employee's portion of FICA taxes paid on these wages should be withheld and deposited as normal. However, in a recent notice, the IRS indicated that it would release guidance allowing eligible employers who pay qualifying sick or child care leave to be able to retain an amount of payroll taxes equal to the amount of qualifying sick and child care leave that they pay under the Families First Act, rather than depositing it with the IRS. The payroll taxes that are available for retention include withheld federal income taxes, the employee's share of Social Security and Medicare taxes, and the employer's share of Social Security and Medicare taxes with respect to all employees. If there isn't sufficient payroll taxes to cover the cost of qualified sick and child care leave, employers will be able to file a request for an accelerated payment from the IRS, and the IRS expects to process these requests in 2 weeks or less. The details of this is new, and we're awaiting further guidance on how this is all going to work. But I'm just going to give you a quick example to illustrate how this works, or how we think this is supposed to work. So for example, if an eligible employer paid $5,000 in sick leave and is otherwise required to deposit $8,000 in payroll taxes, including taxes withheld from all its employees, the employer could use up to $5,000 of the $8,000 of taxes it was going to deposit for making the qualified leave payments. The employer would only be required under the law to deposit the remaining $3,000 on its next regular deposit date. So again, that's just meant to help employers with cash flow to have the funds upfront to pay this leave instead of waiting to process it on their quarterly 941. Okay. The last question we get is, does this mandatory paid sick leave replace existing policies? So this is not meant to replace anything the employer already provides. This is in addition and to supplement what the employer may already provide. So if eligible, employees may choose whether they want to use their employer-provided benefits, like accrued vacation days or paid time off, or if they want to use the paid sick leave under the Families First Act. An employee may choose to use both, but then again, that is the employee's prerogative to choose how they want to arrange this. As Julia said, though, the tax credit for any paid sick leave or expanded family medical leave is capped at the statutory limits, so only the wages required to pay by the act will be covered by the corresponding tax credit. Okay, so moving on into the CARES Act. This is the law that was passed by Congress and signed by Trump last week. It is known as the CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act. It's the third stimulus bill, and it's estimated to cost about $2.2 trillion. And it provides emergency assistance for individuals, families, and businesses affected by COVID-19. We're going to start with the individual provisions. So these are mostly the checks that everyone's been talking about lately. I feel like anytime you read the news, this is the #1 headline, even though this bill includes 900 pages of other language. So the recovery checks are rebate checks of $1,200 per individual and $2,400 for married couples filing jointly, plus $500 for each qualifying dependent child. The version of the bill that passed defines a child as a minor child under the age of 17. This means that adult children claimed as a dependent on a parent's return, for example, college students, do not qualify for recovery rebate checks. So there's that little gap there. If you have an adult child who is claimed as a dependent on your tax return. These checks are expected to go out as soon as Treasury and IRS are able to process the credit refunds, which is likely within the next 3 weeks. If the IRS has your direct deposit information, We're told to expect these recovery checks electronically, and everyone else will get a paper check to the last known address. If you do not get this tax or this tax refund essentially, or this credit, you can recompute it on your 2020 tax return. The amount of the recovery rebate a taxpayer receives is based on information reported on a taxpayer's 2019 tax return. And if you did not file a 2019 tax return yet, again, given the extended deadline, that's going to come up pretty often, the IRS will use your 2018 tax return. If you did not file a return either in 2018 or 2019, the IRS will use the individual's 2019 Social Security income benefit statement. This rebate is technically an advanced credit, so you will need to recompute the credit on your 2020 tax return based on your 2020 income. It doesn't appear that there is a mechanism to have to repay any excess credit if your 2020 income is phased out or your life situation changes, but we will need further guidance from Treasury and the IRS on how they expect to process that. So the benefits of these checks begin to phase out for higher income households. So for taxpayers whose adjusted gross income exceeds $150,000 for joint returns, $112,500 for head of household, and $75,000 for all other taxpayers. Once you're over these thresholds, you lose about $5 of your payment for every $100 your adjusted gross income exceeds these thresholds. So those are the checks, but again, there's a lot more included in the CARES Act, and the rest of the individual provisions primarily try to provide flexibility for people impacted by COVID-19 to get cash out of their retirement accounts. So the CARES Act waives the 10% penalty on early distributions from qualified retirement plans for up to $100,000 of coronavirus-related distributions in 2020. Taxpayers may repay these amounts within 3 years of withdrawal without regard to that year's cap. And although these distributions are otherwise taxable for federal income tax purposes, you may elect to include the distribution in taxable income ratably over a 3-year period, or choose to apply it all to 1 year. The CARES Act also provides a temporary waiver of the required minimum distribution rules for certain retirement plans and accounts. Under this provision, funds related to required minimum distributions, normally required to be made by plan participants during 2020, can instead remain in those participants' accounts. There's also a few provisions for charitable contributions. So taxpayers who do not otherwise elect to itemize deductions are allowed an above-the-line deduction in 2020 for up to $300 for charitable contributions made in cash, not in stock, to any qualifying Section 501c3 public charity, and this excludes donor-advised funds. Additionally, for individuals who do itemize, the CARES Act temporarily increases limitations on deductions for charitable contributions made in 2020. For individuals, the 60% of adjusted gross income limitation is suspended for 2020 for cash contributions, and for contributions of food inventory, the limitations increase from 15 to 25%. Excess contributions may be carried forward to future years based on existing charitable contribution carry forward rules. Finally, the final version of the Senate bill, which became law, also added a last-minute provision which allows employers to provide student loan repayment benefits of up to $5,250 annually to employees tax-free through January 1st, 2021. This extends to both new student loan repayment benefits as well as other educational assistance provided by an employer under current law. So this is like tuition assistance and things like that. So this is a very high-level overview of all the individual provisions that impact individual taxpayers. And Julia is going to talk about the business provisions, which are, there's a lot of them. So moving on to Julia.
Yep, thanks, Yelena. All right, so the business provisions within the CARES Act. So while the Families First Act provided payroll tax credits to companies based on whether their employees were personally affected by COVID-19, the CARES Act kind of takes a different approach, and it provides an employee retention credit, which is based on the economic strain the disease may have on a business. So the rules for calculating this credit are, if you can imagine, even more complex than those for calculating the paid sick and family leave credits under the Families First Act. But essentially, eligible employers will be allowed a refundable payroll tax credit that's equal to 50% of any qualified wages paid. And those qualified wages are up to $10,000 per employee, so a maximum credit of $5,000 per employee. The employee retention credit, it covers situations where a business is either fully or partially suspended due to governmental orders, or it's experiencing gross receipts that are less than 50% of the gross receipts that were received in the same calendar quarter in the prior year. Now, as we mentioned previously, the CARES Act also provides some additional payroll tax relief by allowing employers to delay remittance of their share of Social Security tax that would have been deposited through December 31st, 2020. And instead, 50% of those taxes must be deposited by December 31st, 2021, and then the remainder doesn't need to be deposited until December 31st, 2022. Now, a key note to make here is that if an employer receives a small business interruption loan, which we'll discuss later in today's presentation, then they're not eligible for the employee retention credit. And also, if they've had indebtedness forgiven under the Small Business Act, they're not going to be eligible for the additional payroll tax relief that's provided by the CARES Act. Now, businesses should work closely with their advisors to analyze the trade-off between these benefits, since they're both complicated in their own right, and taking advantage of one may preclude the other. So similar to the provisions for individual taxpayers, the CARES Act also temporarily increases the 10% limitation on charitable contribution deductions for corporations to 25%. The CARES Act also includes a highly anticipated technical correction to the 2017 Tax Cuts and Jobs Act, which is the fix to allow the accelerated bonus depreciation rules to apply to qualified improvement property, also known as the retail glitch. All right, so under the CARES Act, the current net operating loss rules that were put in place by the TCJA are temporarily revised, and it's going to allow losses arising in tax years 2018 through 2020 to be carried back 5 years. Also, that 80% limitation that's applied to determining how much of the NOL can reduce your taxable income, that's limitation is suspended for taxable years beginning before January 1st, 2021. And the CARES Act also retroactively postpones the limitation on excess business losses for non-corporate taxpayers until taxable years beginning after December 31st, 2020. And another note is corporations will be able to accelerate the recovery of any refundable AMT credits that were originally intended to be made available over several years, but instead, thanks to the CARES Act, those refunds will be fully recoverable on the 2019 tax return. The CARES Act temporarily modifies the 30% limitation on business interest expense deductions that was originally put in place by the TCJA. It changes that 30% limitation to 50% for tax years beginning in 2019 or 2020. Now, this is going to allow businesses to reduce their cost of capital and hopefully increase liquidity. And a side note here, the rules for partnerships under this situation are a little bit more complicated. They do provide, however, a bit more flexibility for partners that are allocated any of those excess business interest expense that's limited at the business level and received from a partnership during 2019. And finally, a late addition to the CARES Act was a provision to temporarily waive the federal excise tax on any distilled spirits used or contained in hand sanitizer that's produced and distributed in accordance with FDA guidance during 2020. Now, as you may be thinking, these retroactive TCJA provide several refund opportunities for previously filed returns. So we encourage you again to reach out to your tax advisor for help identifying any refund opportunities that you may be eligible for. All right, so next we're going to cover some of the relief provisions within the CARES Act that are geared specifically towards small business owners. And so this is typically businesses with 500 or fewer employees. The 7A loan program, which is administered by the U.S. Small Business Administration, the SBA, provides financial assistance to small businesses, as you might imagine. The CARES Act comes in and actually authorizes an additional $349 billion for general 7A business loans. The maximum 7A loan amount is increased to $10 million. And then for SBA Express loans, the statutory $350,000 limit is increased to $1 million through the end of the year, so through December 31st, 2020. Now, in general, the SBA responds to those express loans within 36 hours compared to standard 7A loans, which may take up to weeks or several weeks to process. So recipients of 7A loans may be eligible for loan forgiveness on covered loans in an amount equal to the sum of the costs incurred for an 8-week period, starting on the origination date of the loan between February 15th, 2020 and June 30th, 2020, due to payroll costs, mortgage interest payments, rent or utility payments, etc. The CARES Act also gives the SBA authority to provide paycheck protection loans to help employers cover costs, which include wages, paid leave, and state taxes on employee wages. Now, as sort of a late disclaimer to this section of the presentation, I am not an expert on the SBA loan provisions. However, BKD is actually hosting a weekly webinar series on COVID-19 topics, and this week's webinar will cover SBA loans, payroll tax credits, and general business planning considerations. And that webinar is scheduled for this Thursday, so a couple of days from now at 2 p.m. Central. I believe that's 1 p.m. Mountain Time. And you can register at bkd.com/events. All right, so at this time, we're still awaiting guidance to help with the implementation of various provisions put into place, both by the Families First Act and the CARES Act. And much of this anticipated guidance would be in the form of regulations issued by the Department of Labor or the U.S. Treasury. The IRS and the Department of Labor have actually done, in my opinion, a great job pushing out notices and FAQs, reacting to all of this legislative change that's going on. But there's still quite a few unanswered questions that taxpayers and their advisors need. So, for example, there are several places in the new statutes where Congress provides discretion to the Treasury and Labor departments to clarify or create specific rules regarding those paid leave provisions we talked about. Also, the CARES Act unraveled several provisions that were provided in the TCJA. And once we get past the kind of urgent matter of making sure that businesses have enough cash flow to make payroll, that's kind of what our focus has been on now. Then we're going to need some guidance on how to implement those changes that were made to the TCJA and guidance on the refund opportunities and carryback claims that are being made available. And there's also, the lingering assumption that there's going to need to be more legislative relief issued in the coming weeks and months to help continue to help individuals and businesses through this pandemic. So we are monitoring that. It's anticipated, and we just need to see what comes out. All right, so with that, I'm going to turn it over to Will, and he is going to give us a quick summary of some of the international tax and transfer pricing considerations.
Thanks, Julia. So we thought we'd be remiss if we didn't include anything that was international in nature, since we're presenting at the World Trade Center, Utah. And so the international tax and transfer pricing principles will definitely be impacted by COVID-19. As a result, multinational enterprises will need to review their intercompany pricing arrangements. And while the delay of the U.S. tax filing deadline was a welcome development by taxpayers, tax authorities around the globe are going to be aggressively pursuing enforcement, as they'll be charged by their governments to obtain tax revenues to fund the COVID-19 stimulus measures. Governments and public, as we all know, already perceive that multinational enterprises do not pay their fair share of taxes, so they're very unpopular at present. Therefore, international corporations will definitely be in the crosshairs of the tax authorities for enforcement. And in particular, the tax authorities will want to enforce whether or not multinationals are complying with their transfer pricing arrangements and have the proper transfer pricing documentation. This is in contrast with the fact that multinational corporations will experience a significant decline in profits as a result of COVID-19. And so it is possible that multinational enterprises, their transfer pricing policies will not match economic reality due to COVID-19 circumstances. One thing to be mindful of, though, is the fact that when these audits come, they'll actually be a few years from now. So most tax audits are retrospective in nature. And a few years from now, multinational corporations will need to be able to explain any deviations to their transfer pricing policy that they experienced during the COVID-19 years. So it would be recommended to multinational corporations to pay attention to their transfer pricing documentation and the quality of that documentation, and ensure that the narrative surrounding the COVID-19 years reflects what happened compared to their transfer pricing policy that was set at the beginning of the year. The other issue that multinational corporations are going to experience is just supply chain issues and movement of personnel limitations. So again, the transfer pricing policy that's set at the beginning of the year prior to COVID-19 might not reflect the supply chain that's in place today. So for example, a multinational corporation might source their goods from their related party Chinese factory. And as a result of the COVID-19 pandemic, the Chinese factory was offline for a number of months. And so they had to source their goods from another factory down in Mexico. So the issue that multinational would experience would be that they have a transfer pricing policy in place with a Chinese factory to source those goods, and maybe that was on a cost plus basis. And the Chinese factory was no longer producing goods during that period, so they should revisit the fact that maybe that Chinese factory should not get a cost plus basis. And then they would have to put in place proper transfer pricing to account for the fact that they're now sourcing goods for their Mexican entity. So the conundrum that a lot of multinational corporations face is that they usually have transfer pricing policies which employ the use of fixed margins or markups. However, what's going to happen is there's going to be a significant decline in revenues and profits for that multinational during the COVID-19 period. And so they might be paying fixed margins in a lot of countries, but there's a loss overall at the corporation. So really what they need to do is explore the possibility of revisiting their transfer pricing arrangements such that maybe the entities that were getting the fixed margins or cost pluses, maybe they should share in some of the pain and some of the losses that are experienced throughout the company. So they would have to document this fact now. As I said earlier, it's going to be paramount to document in your transfer pricing arrangements and the deviations from your historical transfer pricing now because of the audits that will come in the future. So with that, we've covered a little bit of the international tax issues, but one of the things that I recommend is, as a result of the COVID-19, really all multinational corporations should revisit their international tax and transfer pricing provisions and strategy, and there might have to be a deviation from that strategy going forward based upon the financial modeling. So with that, we're going to open it up to any questions that you all might have.
Hi, well, we have a few questions that have been submitted. The number one question we're getting is if we're able to share the slide deck with all the panelists after this webinar is over.
Yeah, absolutely. We'll definitely share the slide deck with everyone. And I think it will also be on YouTube as well.
Perfect. And another question that was submitted by Chris is, are these employer tax credits in lieu of the payroll protection program loan program, and how do these interplay?
Yeah, I can take that one. So the payroll protection program is meant to help small businesses cover operating expenses, basically. So salaries, utilities, rent. And there is a provision saying that you can use the funds from the SBA loans to cover the paid leave that is mandated by the Families First Act. So they are meant to work alongside each other. But again, remember that the Families First Act, you do have the option of using your employment taxes as an advanced credit to help provide some cash flow. And you can also, if you don't have enough in employment tax, you can also request basically an advance on the wages that you'd have to pay underneath the Families First Act. So they do not exclude, it is not, so participating in the Families First Act by providing that paid leave does not exclude you from qualifying for the SBA loans. In fact, you can use the SBA loan proceeds to cover that paid leave. The only exclusion there is the employee retention credit that Julia talked about is not meant to be used with the SBA loan program. So those are an either or. So you can either take the employee retention credit or you can participate in the SBA payroll protection program. So again, that's the only one where those two are disqualified if you're in one or the other. And the important thing to remember is the employee retention credit is open to all companies. So it doesn't matter how many people you employ. And there are two different fact patterns that you would qualify you for that employee retention credit. And that's either your shutdown or your gross receipts decreased by 50%. And then the SBA loan, that's only for employers with 500 or less employees. And you have to apply for that like any other SBA loan. So at this point, the way we're looking at it is you have to look at what kind of financial relief or assistance your company needs, and then consider the factors surrounding the type of financial need that you have, and to see which one would be a better fit for you, because you do have to choose between those two. All the other provisions we've talked about are meant to work alongside each other. So again, the only two that are mutually exclusive are the employee retention credit and the SBA loan program, which are both under the CARES Act. Okay,
Great,
any other
thank
questions?
you. One more, where can we go to compare the different options for loans and to see if our companies qualify?
So that's a good question. For the SBA loans, you should contact your SBA lender. You should just be able to pull that up on the SBA website based on your location. And for as far as if you're talking about more big picture of which provisions would be best beneficial for you, we recommend you consult your tax advisor. They can help you walk through this. We're putting together currently flow charts and all different types of materials for our clients to walk them through basically cost benefit analysis templates of what provision would best help them. But as far as specifically the SBA loans, those will be administered by the SBA. So you should contact your SBA lender and they can help you get that processed.
Great, thank you guys so much. Julia, Will, Yelena, thank you so much for participating in this. And everyone, thank you for joining in. If you guys have any more questions, please feel free to reach out to Hannah Lowry at the World Trade Center Utah. And please fill out the survey at the end of this and have a great day. Thank you so much, everyone.